Good morning. It's 11 o'clock a.m. and I'll call this meeting to order. Winter, will you please take roll?
Chair Brooks,
Here.
Vice Chair Tarkanian. I see here. Regent Brown. Regent Cruz Crawford. Here. Regent Perkins.
Here.
You do have a quorum. Advisory members, Mr. Garcia, Mr. Densler. Thank you, Mr. Chair.
Thank you. We'll now move into agenda item number 1, which is public comment. Actually, before we do that, let's do the pledge. Regent Cruz Crawford, do you mind leading us? Thank you. Now we'll continue on to public comment. For those who'd like to call in and offer public comment, please dial 669-444-9171 and enter meeting ID 928-4944-5069 and passcode 555555. We'll move to GBC for public comment. Is there any public comment at GBC?
There is no public comment at GBC at this time.
Thank you. Is there any public comment at the system office in Reno?
Yes, there is.
Thank you.
Kent Irvin, ERVIN. Thank you for your service as fiduciaries of the investment funds for the benefits of our colleges and universities. I'm commenting on agenda item 5. NSHE is very fortunate to have the operating fund pool fund, now valued at nearly $800 million, and to be able to manage and invest it to produce supplemental revenue. The NSHE handbook defines the goal of the operating pool investment funds as, quote, the long-term objective of the fund is to provide a relatively stable stream of revenue that equals or exceeds the general rate of inflation, end quote. Shall I go ahead, Chair?
Thank you. Was that, yeah.
That's a modest objective. Unfortunately, the management of the fund has not met the objective of producing a stable revenue stream, much less matching inflation. Regular distributions went to zero for 11 months during the fiscal year 2023, which means that the institutions lost an important source of discretionary revenue. That was during a period of high inflation and cuts to academic programs at several institutions. Cambridge Associates projects the long-term return of the fund at 3.8%, but because of relatively high-risk assets, there is a 50% chance it won't meet the 3.8% target over 3, 5, 10, and 25-year periods, according to page 24 of the presentation for agenda item 5. Currently, Treasury interest rates range from 4.6% for long-term bonds to 5.4% for short-term notes. Treasury inflation-protected securities are yielding 2% above inflation for 5, 10, 20, and 30-year bonds. At these current interest rates, it would be possible to secure stable revenue for decades into the future at very low risk. A laddered bond portfolio with maturities to match cash flow needs could easily beat the rate of return of the current asset allocation and provide stable revenue exceeding the inflation rate, which is the objective. The fiduciary standards for members of this committee is that you should question the financial experts about options and then take action as appropriate. Thank you.
Is there any additional comment at the system office in Reno?
There is not.
Thank you. Is there any public comment here in Las Vegas? Seeing none. Is there SCS? Is there any public comment via the telephone?
There's no public comment.
Thank you. We'll move right into agenda item number 2, which is our consent items. We'll take consent items 2A through 2D. Is there a motion to approve?
So moved. Regent Perkins.
Thank you, Regent Perkins. Regent Perkins made the motion to approve the consent items 2A through 2D. Is there a second?
Second.
Thank you, Regent Cruz Crawford. So we have a first by Regent Perkins, a second by Regent Cruz Crawford to accept the consent items 2A through 2D. I don't know that we need to take a roll call vote on this. I would just ask those regents who are part of the committee to signify with a aye or yes for approval of the motion. Please, regents, please signify by saying aye or yes for these consent items 2A through 2D for approval.
Aye.
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 Thank you. Is there anyone that opposes? Thank you. We'll move on to our next. I'm sorry, what's that? Yeah, thank you. Knock off a little bit of some cobwebs off my shoulder there for that. Thank you. The motion does carry. 2A through 2D were approved. We'll move into the chair's report. And what I'd like to do is welcome everyone to the first meeting of the investment committee. I appreciate everyone's patience regarding the scheduling of this meeting. I certainly like to thank our advisors for their patience, and I appreciate the flexibility and the support of our CFO, assistant CFO, and all the staff from Cambridge. Over the past few weeks, there's been some conversations regarding institutional investments and BDS. For those unfamiliar with BDS, it stands for Boycott, Diverse, and Sanction, specific to any business conducted with Israeli companies or anyone doing business inside of Israel, business with Israel. So in the state of Nevada in 2017, former Governor Sandoval signed into law anti-BDS legislation. At that time, Nevada was the 20th state to have to adopt anti-BDS legislation, and now I believe there's 37 states that have anti-BDS law. So this law protects the state's financial interests by ensuring that taxpayer funds are shielded from the economic damage and instability caused by parties that engage in discriminatory, national origin-based boycotts against Israel and its trade partners. As chair of this committee, I can tell you I have no interest in steering the committee in a manner that would violate anti-BDS law. Furthermore, I would expect that none of our institutions would do so either. Essentially, that may demonstrate a discriminatory act by the institution, and I don't believe that serves the best interest of our community nor the state's economic interest. With that, I'd like to bring our assistant CFO forward as we move into agenda item number 4.
Thank you, Chair Brooks. And good morning, Regents. Rhett Vertrees, Assistant Chief Financial Officer for the record. Thank you for being a part of the investment committee. It's an important role. You've been provided an orientation package as part of the agenda. I'm not going to go through it in detail, but basically you govern 2 pools of investments, an operating pool and an endowment pool. Each pool has policies in place used to meet the goals established by the board over the years. The policies are contained in your orientation package. You will get a review of these pools today from EJ from Cambridge & Associates. Cambridge & Associates is our investment advisor for our operating pool and our outsourced chief investment officer for our endowment pool. Part of their duties are to provide recommendations on policies and on rebalancing the pools to the committee. For example, today you're going to get a request to rebalance the operating pool by $13 million. The details will be provided in their presentation. Both pools are diversified in a manner to meet the board's current long-term financial objectives of providing a relatively stable stream of revenues that equal or exceed general rate of inflation over time. The committee's primary objectives are to formulate, recommend, and implement policies to govern the investment pools and review and evaluate the investments to ensure the pools are within the limits of the investment policies. That concludes my remarks, and I'd be happy to answer any questions.
Thank you. We certainly appreciate your time. Are there any questions from regents? I don't see any questions. We'll now move on to agenda item number 5, operating pool performance discussion. And I'll welcome a representative from Cambridge Associates. And will you be working with the representative from Cambridge Associates to provide comments for this agenda item.
Good morning, Chris Vitone. Chair Brooks, no, we'll just let EJ take the lead and present the reports. Thanks.
Thank you very much. We'll let you take it away then.
Thank you so much. Appreciate the introduction, Chair Brooks. And I will direct everyone's attention to, I will start on page 11 of 38 in section 5. So, for it to pull up here. But this is just essentially looking at the market performance, not just the month of April that you see there on the left-hand side, but year to date. A strong performance to start the year for equities you see in blue. Those are the towards the top right of your screen. Positive territory for the year, but that took a breather in April following some expectation changes in terms of the rates expected for the rate cuts expected for the year. So with more of a hawkish tone, we saw some of the equities sell off a bit in the month of April. That since rebounded a bit in May to get back to about where you were to end the quarter. So not much change in terms of equities, but for this period, fixed income also was down a few percentage points overall for the U.S. Ag, down 3.3%. This was really, again, a month where CPI data came in, March CPI data came in April, and this just essentially, again, reaffirmed the number of cuts that would be expected throughout the year. So there were a couple of bright spots. Gold continues to diverge and show some performance in terms of real assets at real yields. The UK equities outperformed really due to energy and some other natural resources. And then EM also outperformed on the back of some strong performance in China, which is off at up from about 20% from its lows of the year. So impressive bounce back thus far. We'll jump to the next page to just talk through some expectations.
I apologize for, sorry about this. I certainly apologize for jumping in during the presentation just for administrative purposes. And it was my misstep. Just so you know, I'm sitting right next to counsel who leaned over to me and said, listen, please have him state his name for the record. So I apologize for the interruption, but that's part of the process. Thank you.
That I appreciate that. EJ Ogbeche from Cambridge Associates for the record. Thank you. Apologies for the misstep. So looking here on page 12, what we notice is that PMIs, or purchasing manager indexes, showing the confidence in the economy, starting to show some expansion. So on the left-hand side, you'll see all the different regions, trending towards positive territory or expanding territory in terms of the major blocks of our regions. The big picture, Europe has been moving from really a contraction to the expansion, not just UK, but Eurozone as well. We were really close to a recession last year. The US, although we saw a recent downtick in the past couple months in terms of PMI, it's still in the expanding category, and so still positive momentum in terms of growth and growth expectations. When you look at the right-hand side of the screen, you'll see that the US has had some positive revisions, or there's been some growth expectations that now have the US around 2.5% or 2.4% in terms of the expected growth. And that's seemed relatively positive in terms of the revisions that we've seen over the past couple months. Despite seeing the Eurozone and the UK still seeing very muted growth, China has seen some uptick as of recent. So that's something for emerging markets to observe, and likely a tailwind there. Jumping to the next slide, slide 13. This is looking at inflation expectations. And we did see last month that we had some upside surprise in terms of inflation expectations, a tiny bit higher than expected, with the year-over-year inflation recording at 3.8% after many consecutive months of a decline. In terms of contributions to the monthly core inflation print, so you're seeing the not just the G7 or the global 7 countries, but the US there, the 3-month on the left-hand side and the dotted lines. You'll just see that that's a bit more volatile than obviously the year-over-year statistic. And that recent trend upward is what folks have caught attention from economists, worrying that that inflation is a bit more sticky or persistent and stubborn than expected. And so long-term expectations, we still see the trend downward. The darker lines are still trending downward, and the goal is still a 2% target. However, there will be some volatility in the near term, and that's to be expected. You can see it again with the shorter term 3-month month-over-month reading. On the right-hand side, I'll just say that in terms of the monthly core inflation, how it's broken down, you'll see the core CPI reading in magenta, rising a bit to this monthly reading, nearly 40 basis points today, 3.5 basis points. But you'll see a good portion of that is made up of the goods and housing. And we know housing has been a bit stickier with rents, but goods we also see a bit more stubborn than expected with higher inflation in areas like autos. So I'll jump to the next slide, and this is we're looking at expected rate cuts. So on the left-hand side, the market does still expect interest rate cuts coming over this year. In terms of where it started, towards the end of 2023 in December, we had priced in over almost 7 cuts. So you'll see the green line on the left-hand side of the page, near negative 1.5%. Every rate cut is worth 25 basis points. So that's just over 6 rate cuts that were expected to come into the year, or nearly 7. That's been adjusted now down to just under 2 cuts expected as of April in the U.S. And so you'll see that again with the darker green line on the left-hand side. In terms of rate cuts in the Eurozone, they're expecting it to cut a bit more and have a bit more accommodation in terms of the easing. And then the UK is expected, while still to be a bit more than the US, to cut a bit more than the US, to be a bit less than in the Eurozone. On the right-hand side of the page, we look at the long-term neutral real interest rates. And what we observe is that the US has a long-term interest rate average of about 0.6. And so you'll see the green line there sort of covering pre-2022 near -1, and closer to more recent times near 2. The long-term average is about 0.6. And so with that, where we are today at 2.3 roughly, that tells us that we're in restrictive territory, or the real interest rates are restrictive. And so how long will we be in this restrictive territory? That's, we'll know when the rate cuts come. But until then, we're still at a point where real interest rates are restrictive for the economy. I'll jump to slide 15. Just spend a minute here. This is looking at earnings and looking at valuations essentially. When lots of talk about the Magnificent Seven and the other 493 stocks, this sort of captures that in looking more at the broad U.S. market. And so On the left-hand side here, we sort of disaggregated the EPS growth, the earnings per share growth, in the darker lines. So if you look at the dark green line, this is earnings growth in the U.S. at the end of 2022 or beginning of 2023. If earnings have grown since then at about 11% from then to now. But if you look at the price return or the light green line, prices have appreciated about 32%. And so that disconnection is what is driving up the valuations of stocks. That divergence creates that higher valuation. And so we're seeing very expensive stocks in the U.S. is the punchline. And that this is a lot of the reason why much of it is coming from this price return rather than the earnings growing. And that's sort of the big question. Will the earnings continue to grow to support these prices, or will valuations have to correct over time? When we look at valuations on the right-hand side of the page, we see that in the U.S., valuations are over 24 times in terms of the price to earnings. The PE, so the middle green bar of on the right-hand side of the page, is showing the price to earnings again. And we just, again, are showing that these valuations are fairly high, even when you strip out cash and other metrics. Yes, question? Sorry. Okay. I'll a couple more slides here. On the next page, page 16. This is really just looking at small cap versus large cap stocks again, driving home again the point that we saw a lot of performance in the Magnificent Seven or a lot of the larger mega cap tech stocks in the U.S. And small cap stocks had really suffered to start the beginning of the year. So we think that there's still some value there today, given the pullback in prices, but also observing that on the right-hand side, we've noticed this historical correlation that when ISM manufacturing is improving, the small cap stocks tend to do better in that environment. So small cap stocks, if you see in the green on the right-hand side of the page, this is their return versus the U.S. Stocks. Their relative performance hit a relative low, in the middle of 2023, and have now sort of bounced back a bit with recovering ISM prints. And so the tailwind there for small caps is the. So finally, I'll move to slide 17. And here, I think this is just showing money market funds. So on the left-hand side, in dark green, you'll see the increase of money market funds and the rapid increase of money market funds, and just what's supporting that. On the right-hand side, you'll see flows or outflows really from U.S. equities, while fixed income is staying relatively static. I think the point is that that cash has been moving out of equities, but it looks like it's been moving to some of these short-term money market funds that you will get some return for a short period of time. But once that rate resets, you'll have to accept the rate in the new environment. And so that's some of the challenges of always accepting a shorter term, higher interest rate that might reset at a point where it's not as favorable for your portfolio. So I will pause there. And actually, let me just finish on page 19. I see page 19 just shows some of the asset class values. And I'm happy to speak to slide 18 as well if there are questions around private investments. But to just finish the conversation on valuations here, we look at this not as a decision guide, but really as just to help contextualize the environment that we're in. So when we look at equities, the blue on the far left-hand side, we see developed market equities, U.S. equities, and growth equities are very richly priced in the 90th to 100th percentile of their historical prices, as well as gold. this doesn't tell us that we should sell all of those assets, but it just gives us some context as to where they are in the current market environment. And conversely, because China A shares are very cheap, does not mean we should be loading up on China A shares at this point in time. I'll pause there if there are any questions.
Thank you. I know that we appreciate that. Are there any questions from committee members at this time? Are there any questions from regents who are attending this committee meeting?
Mr. Chair, Regent Perkins here.
Go ahead, Regent Perkins.
Just a comment. Thank you it's a lot of complex information, and you've explained it very well and made it almost clear as mud. I'm just teasing, but yeah, it's you've compacted a lot of complex data into very concise slides that are easily understandable. Thank you. I appreciate it.
Thank you, Regent Perkins.
Great. You know what? Our assistant CFO might have a question.
EJ, do you think you ought to go through page 8 on the rebalancing activity? Because that's for approval.
Yeah, that is not, yes, that's
Okay.
the next item.
Thank you for bringing that up. I do have just a couple of questions, and maybe there's something you can help with. So I know you mentioned the Magnificent Seven. For those who might not know what that 7 is, would you please list what those 7s are?
Sorry, I got caught on mute there.
That's okay.
So the Magnificent Seven would include the likes of Tesla and Apple, even though they've been underperforming as of recent. Facebook, Microsoft, Google, Amazon. I think that's 6.
Nvidia.
Mentioned Microsoft. NVIDIA, of course.
Yeah.
I'm sorry. That's
okay.
the biggest one that I missed.
And thank you, I appreciate that. And then the only other question I have based on the slide that you have up right now is, are there any recommended asset allocation changes when you're taking a look at U.S. equities and U.S. growth equities?
No, I think, a lot of the decisions that we end up making, some of the most important decisions that we can make are around asset allocation. And we generally don't move so quickly around that asset allocation because we give the latitude to our managers to perform in the given environment that we set them up in. And so when we think about asset allocation, because certain assets are richly priced or cheaply priced, it doesn't necessarily indicate that we need to change how we're positioned for the long term, for the very long term. But there tend to be at times some opportunities for rebalancing, for example. So if the U.S. equities have done really well over the past year, that tends to be a source of spending. So we'll sell equities that have done well to use that in other areas of the portfolio that may be cheaply priced or under allocated, under target.
Thank you, I appreciate that. I don't have any further questions. Thank you very much.
I had a question.
Yes.
Yes, I was just wondering, did we ever invest in Bitcoins?
We did not direct and invest in Bitcoin. We did not direct in a manager explicitly for that exposure. There are some venture managers that have exposure to blockchain and some of the AI features that are incorporated with Bitcoin, but not directly a Bitcoin asset in the portfolio.
Thank you.
Thank you, Regent McMichael, for that question. Are there any other questions from Regents? I don't think we have any. Feel free to please continue. Thank you.
Great. So jumping to page 8, I want to take a second here to just orient folks on this slide who may not have seen this before. When we look at the portfolio, we'll have our quarterly reports that we get, and that's what gets populated into this green column on the far left-hand side. That's the allocation that we know from our reporting that gets reported from the managers. We estimate performance based on the benchmarks and the proxies that we have for each of these assets over the different periods. So you'll see here that for the month of March, where we've estimated the estimated performance here was for the long-term pool was 2.5% for that period, and the intermediate pool was 0.7%, and the short-term pool was 0.4%. Similarly, we have that estimate for April in the next column. Then we show you our estimated assets after the performance changes, the NAV. And then in the yellow column here, towards the middle right of the page, that's where we're recommending trades on your behalf. And so what we've recommended here is trimming from our U.S. equities and our global ex-U.S. equity allocation to essentially fund more of the Treasury Inflation Protect securities, or the TIPS, $5 million to the short-term Vanguard TIPS, and equally $4 million to both bond managers, PIMCO and Allspring Core. The opportunity here, again, addresses some of the concerns around the yield in this current environment. Can we have a portfolio that's yielding more, throwing off more yield of a return to the portfolio? This would address that. It also addresses Chair Brooks' point about rebalancing, and that when there are assets that have done well, that is where we look to trim to then reallocate across the portfolio. So that's essentially what's happening here. We're taking 13 million from Vanguard Institutional Index and Vanguard Developed Market Index, and we're reallocating that to the TIPS, the short-term TIPS, Vanguard short-term TIPS, and then the PIMCO and Allspring bonds. We then show you what that pro forma allocation would look like in the next column. And we show you again what that, where that lies in terms of the ranges, the allowable ranges that were guided from by the investment policy statement. So hopefully that helps kind of walk through not just how we think about this document left to right, but the different pools that are associated, the long-term pool towards the middle of the page. You'll see the total long-term pool, total intermediate pool, and then the total short-term pool. And that gets us to our assets today, or as of the end of March, excuse me, 784 million estimated assets at that point. I'll pause there, because there is the recommendation in there.
Chair Brooks.
Regent Borland?
Thank you, sir. Appreciate it. If I may address Council, looking at these, welcome back anyway. Looking at these investments here, may I go back to a previous item on the agenda, and that was the Chair's remarks. I want to combine the two. May I do that, Council? Attorney General, ma'am?
Linda King, Associate General Counsel. Let's see where you're headed, and I'll let you know.
Okay, thank you. Looking at all these things, and I know the young man isn't finished yet, and there's a tremendous amount of stuff. I wasn't feeling too good. Now I'm feeling worse looking at this, but just, and it's great stuff. The chair mentioned something about BDS, and I wish that he would go into more detail, because I feel people don't understand that enough. I don't see any of our investments here in any companies from Israel. So if that's the case, then I'd like to know if the chair knows more about this. Why is there this uproar about us investing in Israel? Because I don't see anything here. Is there any other investments that we have that might be involved in that, Chair or Council?
Regent Borland, it's Chair Brooks for the record, and I greatly appreciate the question. And you and I share the same opinion in terms of educating others on some of these things, but unfortunately, for the purposes of this meeting, the way the agenda items are set up, diving into that would not be the course that we're set on for today's meeting. However, I would encourage you to perhaps, whether it be today or another upcoming meeting, bring something like that up in a new business.
Thank you, Chair. I really appreciate that. One more question, though, very short one. May I, sir?
Yeah, go ahead, Regent Borland.
Thank you. Appreciate that. So I can ask the young man here that we have no investments in Israel as a NSHE system, not just UNLV. Right, Mr. AJ Ogbechi? We have no investments, right?
Am I able to answer that here?
Yeah, Linda King, Associate General Counsel for the record. You can, to the extent that you're able to answer that. I know that that's a very complex question, but to the extent you have any information available, please feel free.
Thank you, ma'am. Go ahead, sir.
Yeah, so thank you for the question. In terms of direct investments, there are no direct investments in this portfolio to Israel. What we tend to try to provide is just more context and color that, of course, different countries could be investors in certain assets, but
sure.
if we have a commingled fund, we aren't owners of those assets, and so we don't pick and choose what goes into those funds. And so, from that perspective, no, there are no direct holdings in this portfolio to Israeli assets.
Thanks, Mr. Ogbechi. I really appreciate that. So all this nonsense that the UNLV and all is not worth it, they're wrong about. We have no investments. I want to make that clear. Thank you so much, sir. Thank you, ma'am. Thank you, Chair.
But I would also clarify that that doesn't preclude Israeli investments into U.S. instruments, for example, treasuries. So that doesn't include how much exposure Israel has to our treasuries, for example. But yes.
But NSHE doesn't have any, so there's no need to mention U.S. interests in Israel or Israel interests in U.S. We're talking about NSHE. There's none. Thank you, sir. Appreciate it. Thank you so much.
Thank you, Regent Borland. If you would like to continue with the presentation, I think we don't have any more, the body doesn't have any more questions.
So with that, I would simply recommend the rebalancing the action items on page 7 of Article 5 to trim U.S. equities and global equity and rebalance towards chips and long-term bonds.
Regent Perkins here, I'll make that motion to follow the instructions, the executive summary of rebalancing the operating pool.
Thank you, Regent Perkins. I appreciate that. So for agenda item number 5, the motion to approve was through Regent Perkins. Is there a second?
I'll second it.
Thank you, Regent Tarkanian. So on the floor is a motion to approve the operating pool performance recommendations by Regent Perkins, seconded by Regent Tarkanian. All those in favor, please signify by saying aye or yes.
Aye.
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 Aye. Those who oppose, please signify by saying no or nay. The performance pool recommendations have been approved. Thank you. We'll now move into agenda item number 6, the endowment pool performance. And I believe we will still hear from a representative of Cambridge & Associates.
Correct. Again, EJ Ogbechi, Cambridge Associates for the record. So I will start on page 9 of Article 6. just to highlight performance, we have performance listed here through March, our most recent performance report. And so we observe here that we have calendar year to date, the total endowment is up 4.4%, 20 basis points ahead of the policy benchmark. For the longer fiscal year to date to June, we have the portfolio up 9.6%, 100 basis points ahead of the policy benchmark. And we similarly over the 7 years that we've worked together since March 2017, we have we show an 8% annualized performance versus the 7%, so 100 basis points of outperformance each year over that period. When we look at wanted to point out here as well, the Russell assets now are just at 228, or about 229,000. So de minimis part of the total assets that you see here, but we've segmented that for you. Let's jump to page 10. What I'll do is sort of walk through each of these slides, again, for the context of, for everyone to have the context, but then I'll try to explain it as best as I can. So if you have questions, please feel free to stop me. What we show here is that the total endowment shows a better risk-adjusted return than the policy benchmark. So the two orange note marks there for total endowment and the policy benchmark. How to read this chart, on the x-axis at the bottom is the standard deviation, or also the volatility, potential movements in the portfolio. This where the benchmark is at just under 14%, at 13.9, as you see in the table there, also on the right-hand side. And with that volatility, the average compound return has been 5.7% for the benchmark. On the y-axis, again, that's the return, showing that again, that 5.7%. And so where you actually want to be on this chart is up and to the left, sort of not counterintuitively, not up and to the right. But the lower the volatility and the higher the return, the more confidence you have in the dollars that are in the portfolio. And so, very pleased to see that the total endowment has an annual compound return of 6.9% with observed notably lower volatility than the policy benchmark at 12.6%. That ratio, the ratio of the return to the standard deviation, is captured in the Sharpe ratio along the right-hand side of the page. The higher the Sharpe ratio, the better risk-adjusted returns. So again, at 0.44%, 0.44, excuse me, that's better than the policy benchmark at 0.31. So jump to page 11. Just talking through some performance drivers here. This is fairly simple because every sort of subsection is muted except for manager selection, but I'll walk through each. On the far left-hand side, you see the policy benchmark. That's the policy return over this period. We're looking at the full track record for our OCIO track record through September, because that includes our most recent private investment performance. So when we look at that entire period, including our private investments, so fully baked performance, what we see is that, again, on the left, the policy did a 5.9% return during that period. Intramonth activity, those tend to be flows or cash flows that, if we enter a manager mid-month versus the end of month, and we see some drag on performance, that would show up there. Similarly, if we timed it perfectly and we entered a trade right before it doubled, we would see that performance there. The point being, over the long term, we don't expect we expect that to be muted, or roughly zero. We don't expect to time trades and getting in and out of trades. But where we do expect to add value is in the manager selection, and that's why we have the extensive resources we do in terms of our research, particularly in private investments. And you'll see private growth, where you have your private equity and venture managers, have added nearly 50 basis points to the outperformance over this period. U.S. equities also did very well, and also the marketable alternatives or the hedge funds, in addition to the emerging markets, all added value to the portfolio, whereas global equity and fixed income detracted a bit for this period. Manager structure, when we look at a manager's, you all wouldn't, we wouldn't show this necessarily here, but when we look at the manager versus their explicit benchmark, observing that difference would show up in the manager structure. And then when we look at an allocation to, for instance, U.S. equity, looking at that versus a policy target, that's where we look at, that's where we would understand any differences or divergence in asset allocation. All that to say that the 150 basis points of outperformance that you see in the manager selection transfers to the portfolio return outperformance and the value add that we have in that performance on the far right hand side. So that 7.4% of a return over this period is what you would see. When we look at the calendar year 2023 on the next page, it's a bit more convoluted, and I'll refer to, we'll use the following slide after this even to help provide some more color. But what you're seeing here, again, during that, we would expect manager selection to be where we would have that value add. Over this period of time, you see that private growth or venture and private equity really detracted a lot from the portfolio performance. So, the lion's share of the nearly 250 basis points of underperformance, or 150 basis points of underperformance. We should observe is that because this is over a shorter period of time, not only are private investments not fully accounted for in this period, but private investments are benchmarked against public investments, and so there is naturally a mismatch of when that performance is marked. For example, when we have a private investment, we're looking at performance 3 months in arrears versus a public investment performance that's marked daily. So we can get public equity S&P quotes immediately and daily, but we can't get that with our private investments. And so because of that mismatch, I want to jump to the next page, slide 13, to just show how we've observed this dislocation over time, not only in the tech wreck in the first or red circle on the far left, or the financial crisis in the middle of the page, or COVID. Each period has seen this moment of dislocation where there's a sharp correction, and public markets, shown by the darker blue line, will contract far more than private markets in the lighter blue line. And in the recovery, in the following year of a recovery, public markets will do really well, but the private investments will be a bit more muted. And really the punchline here is that over time, private investments really do add value, and that's shown by the black solid line trending up and to the right over this period. And really that's just to show that, again, where we find most of our opportunity is really in private investments, and that's where we lean the portfolio and really rely on that performance, despite the near-term dislocations that you might see again on the prior page. I will jump to the next page, and I'll go through these next few pages just as a quick sort of overview, because these are standard slides, again, that we share in terms of we share about our portfolio risk metrics each quarter. Here, the risk and return on the left-hand side is a 5-year chart. On the right-hand side, 10-year. Again, just looking at the observed return during this period and the volatility. Whereas on the left-hand side, you see, again, in blue on the table towards the bottom, 6.4% return with a 14.4% standard deviation gives us that 3.2 or 0.32 Sharpe ratio, which is favorable compared to the benchmark. Similarly, over longer periods, over that 10-year period, we look favorable versus the benchmark. On the next page, very quickly, when we think about evaluating our performance, we think about three different periods or three different ways to evaluate the performance. So when we look at the policy benchmark, that's the shortest term metric that we'll use to evaluate performance over a rolling 3-year period. We use the simple 70-30 portfolio to evaluate performance over the longer 5-year period, 5 to 10 years. And then when we look at the very long term, that's when we incorporate the distribution policy, or a certain percentage plus inflation. And that's over the longer 10-year period. And so when we look at the following 3 slides, it will go through just exactly that. And so on slide 16, you have the 3-year rolling benchmark comparison, and currently sitting above the benchmark there favorably. Similarly, with over the rolling 5-year return and over 10, it's where you'll see a bit more of the volatility. Today, we're sitting below that CPI plus spending mark, but again, that is more volatile over time, and you see the average there is roughly close to the benchmark. I will pause there for any questions. No, that was a lot.
Thank you. We appreciate all the information. Are there any committee members with any questions? Are there any regents who are attending who are not part of the committee that have any questions? I appreciate that you paused for us. We don't have any questions at this time. Thank you.
Great. I will keep plowing ahead. So the next few slides, slide 19, sort of the cover page for this. This is really just about our asset allocation, our compliance. And so some of the metrics that we use to help guide, again, the portfolio are on the following pages. So page 20, when we think about the allowable ranges for the portfolio, you'll see that we are well within those ranges and comfortable with the portfolio positioning as of today. So that's, again, one of the metrics that defined by the policy statement that guides how we manage this portfolio. It's the following page, looking at liquidity. Again, do we have the compliance guidelines here shown below to show that we are, again, in compliance in terms of the total portfolio. When we segment the different liquidity and how much we could get during these different periods. So daily, weekly, quarterly, and so forth. We segment the entire portfolio, and we are in compliance. And then I will jump to page 23 and 24. So this is also looking at sort of the risk return profile of the portfolio, but some of the metrics that we use to help guide some of the decision making here. When we look at the portfolio's long-term expected return, lots of sort of testing to support this, but the punchline on the right-hand side, the darker blue line, the policy will show that we'd estimate that 5.9% return of compound returns over time. And that's really sort of the crux of this portfolio or this slide. And why that's important is when we look at the next page, page 24, that 5.9% expected return is what you're seeing on the bottom of the page here, bottom left. You'll see that long-term targets, and the shaded line of the shaded 5.9 region shows that that's what we would expect the portfolio to return over the very long term. But based on the simple math of where valuations are today, the expected return of this portfolio would actually look more like 2.4%. And I'll break that down a bit more for you here. When we look at, we have sort of 2 periods of time that we look at. The return to normal is looking at a very simple math problem that says, looking at the long-term historical average of prices and valuations based on where we are today, what would the returns have to look like to return to the mean, or to revert back to the mean? So if the long-term return is 6.1% for global equities, based on where we are today, the outlook would actually say that we should only expect about 1.1% from our global equity allocation. So if that is helpful, just a simple math equation saying where are we today in terms of valuations, and where would simple reversion to the mean take us? So this breaks down each asset class, about where that each asset class would revert in what the performance would look like if each asset class were to revert to the mean, and where the long-term equilibrium average would be otherwise. And so you see that disconnect, or that dislocation, predominantly in equities or the blue bars. They'll show you the dislocation, or the idea that there's public markets are very overvalued, very richly valued at this point. Equities are. But conversely, when you look at the orange bars towards the right, where you have some commodities, you'd see that the current prices, or the return to normal price scenario, is higher than the long-term equilibrium average, simply stating that the opportunity is cheaper than it historically has been in the past. So we take all those mathematical inputs and we spit out a formula that gets us to roughly our expected return over the long term, and that's where we get that 5.9%. But wanted to quickly walk through how we get there.
Thank you.
Because on the next page,
I'm sorry for interrupting. For the record, it's Chair Brooks. So I just have a question in terms of the deflation, right, at 0.08 with U.S. Treasuries. And I know I'd asked if there was recommendations with U.S. equities. Is there any type of recommendation that you would have regarding where we are with that?
Yeah, I think the recommendation would be to not be over allocated to U.S. equities at not very much past beyond target. And if we do get to target or beyond target, it's probably due to this price appreciation or the valuation expansion that we sort of touched on earlier in this presentation. And so because of that, the recommendation would be, from my perspective, to trim and rebalance, not position our entire portfolio such that we never, or our long-term portfolio is not going to be, will be then underexposed to U.S. equities. That wouldn't be the decision that I think we make from this. I think it would be a more tactical near-term trim or repositioning of the portfolio rather than a long-term asset allocation adjustment.
Thank you. I appreciate that.
Just to bring it home here a bit, so the 5.9% again that you see towards the middle of the page, if you think about the normal distribution, the 50th percentile in the middle is what we're showing here, shaded in brown, and that 5.9%, if you're looking at the top chart, is right where that black bar is across each of those time periods. And so what we're saying here is, over the shorter term periods, you should expect some volatility. That's not because of any risky assets that I think we particularly own, or that would be unusual. But this is simply the volatility that you would expect over a short period of time for this portfolio, given our asset allocation. Over a longer period of time, you should expect to get closer and closer, or more. You should be more confident that you would get closer to the expected return that we have of 5.9%. So you'll see that over time, that brown band gets smaller and smaller over the long-term 25-year period. And that's really what we're saying. I think over the longer term, we have more confidence that it will fall in that range and be closer to that 5.9% than we would in the next 3 years if someone were to look at our performance then. So let me jump to the next few slides and then just orient folks, and I'll pause here after this. So slide 27, just to show we segment the hedge fund program, or the diversifiers program, how the different types of managers we show here, just how we're diversified across different types of sub-asset classes. But helpful here if you have a particular question around, well, do we have exposure to credit or long short hedge funds? This would help answer that question. terms of private investments on the next page, this helps walk through the commitments that we've made recently. So on the bottom part of the page, you'll see on the far right, 2024 commitments. And then as you move to the left, previous years. And then we list the different asset classes where we've made those commitments, showing the diversification in the portfolio. On the top, we sort of express not just where the positions are today, but how much we have unfunded and would expect to be calling, or how much those positions would expect to grow in terms of their NAV without any marks. So just a good overview here of our private investment program. And then the next slide sort of has some high level funding status and performance, but won't spend much time here. I guess the one thing I'd point out is the long-term outperformance that managed private investments of nearly 14% versus the benchmark. So very strong over that period. We'll pause there.
Thank you. Are there any questions from committee members? I don't see any. Are there any questions from Regents attending the committee meeting? We appreciate the pause. There are no questions for you.
Great. So those are all the prepared remarks for performance and sort of the risk section of the portfolio. Next, I would move to the sustainable investing and the diversity section, unless there are any questions. So,
I'm sorry for interrupting. I just wanted to, as you start to move into the endowment pool performance, I just want to make sure I understood what you were saying. Are you now moving into the pool performance? Because that would be another agenda item that we have, and I just certainly for the public want to clarify if we're jumping into that agenda item number 7.
Not moving into a comparative performance.
Okay.
This is still part of items.
Thank you.
So this will be fairly quick. Page 40. We took a look at the. Sorry.
Go ahead. I don't believe there's a question on the floor. Thank you.
No worries. Very plainly, I think what we were asked, to do is to just look at fossil fuel producers in the endowment portfolio. And, oftentimes when we do this, we will compare versus a benchmark to just understand, versus the portfolio benchmark to understand, where we sit. And so when we looked at this, when we looked at the public equity allocation, we do observe that 3.3% of the portfolio is exposed to fossil fuel producers, but that's almost 50% lower than the ACWI benchmark. And so we view that favorable, and that has trended downward. There are also private investment commitments that over time, will essentially fall off of the exposure of the for the endowment. And so today, I think here we noted that slightly more than 18% of these strategies are directed towards sustainability. And probably the next slide, page 43, is sort of the best way to segment that or look through that. 43, yeah. And so as of the end of last year, we have, in each asset class we segmented just exactly how much we have, how much exposure we have to sustainable investments. And so we sort of described those there, but I'll again use that as more of a leave behind for informational purposes rather than sort of list through each one. And I guess in the next section, I'll jump to page 47, talk to page 47 really quickly first, because this sets the context that, less than just 1.5% of assets on the top right-hand side are managed by diverse-owned firms. That's women or people of color. And there's just significant underrepresentation for women and people of color in the investment professional world. And so a lot of the statistics on this page help support what this portfolio is doing on the prior page. So what we show is that the NSHE endowment has nearly over a quarter of its assets, 26% of its assets are managed by significantly diverse firms, and 17% managed by majority diverse firms. And how we look at that, anytime we look at an organization, we are trying to understand the diversity of an organization. We're not just looking at the ownership, but for certain products, it makes more sense to look at the firm management team. Or certain instances, it makes more sense to look at the strategic leadership or the investment committee of that product. And so we have a holistic view when we look through each of these managers. But when we do that, we observe again that either significantly diverse, which is over a 33% tipping point. You can go to the prior slide, page 46. 33% diversity, women or people of color, and this portfolio has 26% exposed to that, and then 17% of the portfolio is majority diverse, or with managers that have more than 50% women or people of color. So those are all my prepared remarks. I think any other slides are more for a leave behind, but I'm happy to take any questions if there are some.
Thank you. We appreciate all that information. Are there any committee members that have questions for EJ regarding his presentation thus far? Regent Cruz Crawford.
Regent Cruz Crawford for the record. My question is on slide 47, that first chart of the that first pie chart. Is that representative of managers, are you saying? Oh, you're on mute.
Of course, I'm sorry. So that is actually just the makeup of our U.S. population. So that's speaking more generally, and it's just pointing to the disparity among the two, where our population is very diverse and near over half women, but the diverse-owned managers represent less than 1.5% of the investment management group. So,
and then the one on the right is ownership, correct?
Correct. This is ownership.
Thank you.
Mm-hmm.
Are there any other questions from committee members? Are there any questions from regents who are attending the meeting? Okay. Would that conclude agenda item number 6 for you? And we'll move, if that's correct, then we'll move right into agenda item number 7, which is the comparison. Thank you.
CFO Baton, did you want me to address this first?
Chris Fatone, CFO for the record. Yes, EJ, if you would, please.
Excellent. So Article 7, the comparative performance, this shows performance through the fiscal year 2023. So this is ending June 23. What we see here, sort of section A, top half of the page, assets under management, you'll see NSHE, and you'll also UNLV and Reno to the right. What we show in section B is historical returns. We have the 5-year returns there for each year. But section C might be a little easier to see the compound return for those periods. So the 5-year compound return I will be looking at NSHE without Russell for this period in green. So that 13.7% towards the very middle of the page shows the 3-year annualized return of the NSHE portfolio without Russell. So 13.7% for fiscal year 23, fiscal year 22, and fiscal year 21. That, compared to the net performance there of UNLV and Reno, slightly favorable, but still very positive in that period. Over the 5-year period, 9.5% disaggregating the Russell portfolio. Over the longer six and nearly 6.25 period, 9.6%, so very similar. And then over the 10 years ended in June 2023, 8.2%. When we look at the volatility, so I'll jump to section E to show the Sharpe ratio because we talked through so the risk return metrics showing that more volatility is not favorable. So the higher volatility here is not necessarily favorable, but when we take both the compound return and the standard deviation together, that's where we get the Sharpe ratio in section E. And that's where you'll see 3 years ended, very favorably, 1.01, 5 years, 0.59, and then the very long term, 10 years, 0.68. I'll pause there if there are any specific questions, but I'm happy to address.
Thank you. I appreciate that. Are there any questions from committee members? Are there any questions from Regents? Would you mind doing us a favor, just for the context of the presentation, can you explain why Russell would be listed on here to begin with?
Yeah, so during this period of time, Russell, there was a period of time during the 3 or 5 years where Russell also managed part of the portfolio. And so to disaggregate that, or to show the mandate that we had, which was very separate from Russell's versus Russell's, we disaggregate that here just to show for clarity. But you could simply take them all together, which would be 2 different advisors, or you can just either pull out the Russell to get that understanding. We provided each of those there. So
thank you. I appreciate that.
I believe it was at the beginning of 2022 that Russell, that we moved away from Russell.
Thank you. I don't think there's any other questions on that. Is there anything from you, Mr. Baton?
Thanks, Chair Chris Fatone. No comments from me. I don't know if there might be any from the foundation representatives.
Yeah, thank you. Are there any advisory members who would like to pose any questions regarding the performance? I don't believe we have any with us. Thank you very much for the presentation. I'm only going to assume that would have had concluded your comparisons and everything that you wanted to deliver to us. We've heard from you on and been able to follow along with you regarding your presentation. Thank you very much again for your flexibility with scheduling and then rescheduling this meeting. We certainly appreciate your expertise. So thank you again. If there are no questions by committee members or regents, then we will move right into agenda item number 8, which is new business. Are there any regents who want to suggest items for new business? It looked like Regent McMichael perhaps was signaling. Regent McMichael, do you have some new business?
No, I was just making sure that Borland gets his say for new business.
Okay, all right. Well, thank you. Regent Borland?
Thank you, Chair. I must thank Regent McMichael for that. Really appreciate that. Chair, through you to the counsel from the AG's office, if I may specify a few things here. It says in new business, limited to description, which I will describe, and clarification, and I will clarify the subject matter of the item, which may include the reasons for the request. So it says may include, I will take that opportunity to include.
Yes.
Also, it says that there may be no substantive discussion. So I will request you, counsel, to make sure that no other regent speaks up and that becomes a discussion, because they like to stay silent about everything. So they should stay silent while I'm making this. I don't want a discussion. Thank you, ma'am.
Linda King, Associate General Counsel for the record. Regent Boylan,
Yes, ma'am.
I work for the Board of Regents. I don't work for the Attorney General. Just, I know it gets confusing. Sometimes we have other attorneys present, but
Oh,
yeah, I work for you.
Okay. Thank you so much.
And you've
I like that even
identified
more.
how to list new business. And you'll
Yes,
recall
ma'am.
discussion, we don't want you to be discussing the item either, but you may go ahead and identify those things for your new business items that are reflected on the agenda. Thanks.
I appreciate it because the discussion doesn't come from one person only. It comes from more than one. So I want to be the only person here. So thank you so much. And back to Chair. Chair, thank you for your patience. I would recommend, and I'd like to see an agenda item, about this BDS and what it means, how it affects NSHE and all the institutions. I'm clarifying it by saying this is something that was going on for our two presidents, North and South, and I don't know anywhere else. And this is a talk that's very, very, very important for the day and time. And I'd like you, sir, to do a presentation like the fine one you did last year, but on this topic, BDS, and how it's affecting these people who are protesting about this. So I'd like to, people have asked me, and I cannot answer. I really cannot. So they've asked me about this, and they're like, what the hell are you guys doing up there? Make a clarification about this. How are the presidents involved in this BDS? What has been said and has not been said? No discussion, please, anybody. So I will include the reason for the request, and the reason is the safety of all our students, especially our Jewish students, on all the campuses. So I think you, sir, have had good experience in this, and I'd appreciate it if you would do us a big favor, a big duty to all of NSHE, and do us a presentation, have an emergency meeting, because this is not something that can wait. Just because school is closed doesn't mean we should just stop. This is going to keep happening, and you know it, others know it too. So that's my request. Did I do well, Council? Miss King?
Linda
That's good
King,
enough, right?
for the record. Yeah, that's fine. It
Yes.
looks like you're requesting a new business item for the full board and not the investment committee. Is that correct?
See, I knew you'd catch me somewhere. You lawyers always do. Okay, let me see.
Just if you could clarify so that board staff knows where your request lies.
I think I would first ask for it to be a committee meeting, because then the chair has the authority to call a committee meeting. By the time I request 5 other regents to sign up for a special meeting or put it on agenda item with 3 other regents, forget about it. These regents are asleep when it comes to important matters. They don't stand up for something that's really important.
Regent Borland, I appreciate your passion, but
Yes.
but we want to stay on topic with the
Sure.
item that you're bringing forward. And
You're
just
right.
for the record, I want to clarify
Yes,
that
you're right.
part of your request is that I provide a PowerPoint presentation regarding what BDS is.
Yes, sir. And how it's affecting NSHE and all the students and how it's affecting business for us, because it's very important. So yeah, would you please, I'm requesting that it be part of this meeting where you're the chair. Is that better, ma'am?
Linda King for the record. The scope of that agenda item, if it came through this committee, would be limited to the
Yes.
scope of what this committee deals with. Just so that
I
you
see.
understand, if that comes forward, it would be limited to the scope of the jurisdiction of this committee.
Okay, thank you so much. But I know it will come forward if the chair so wishes to do so. So I would start with a small step and just come with this committee, because by the time I ask for it to be on the main board committee, we might not hear about it.
Thank you,
So
Regent
it's my
Boylan.
request. Yes. So you cannot say that I didn't say that or ask for it, Chair Brooks. Thank you so much for your patience.
Okay. Is there any other new business? Okay. Seeing none, we'll move right into agenda item number 9, which will be public comment. Let me get my little disclaimer for those who would like to call in and offer public comment, please dial 669-444-9171 and enter meeting ID 928-4944-5069 and passcode 555-555. Is there any public comment at this time at GBC?
There is no public comment at GBC.
Thank you. Is there any public comment at the system office in Reno?
There is not.
Thank you. Is there public comment here in Las Vegas? Go ahead.
Yes, sir.
Dr. Bill Robinson, economics professor, macroeconomist, 44 years teaching this stuff to our students. I just want to clarify a couple things that was said. One is, I don't expect there's going to be a rate cut this year. I don't. They said they're expecting 2. I expect O. Inflationary expectations on that graph is more important than the actual rate of inflation to the Fed. And inflationary expectations are going up. And the way we break those is raise interest rates. So I don't see rate cuts. I see, if anything, the opposite. I see the Fed being more concerned. 2, there's a reason why portfolios are the way they are. And the idea that we would put all of our eggs into one basket, even over time, the equities outperform all the other assets if we look at historical assets that we're invested in. Sometimes when you invest heavily in equities, you're going to have bad years, and you're not going to have money to disperse out of that fund, or your money is going to be less, or your fund is actually shrinking. There are years I have not looked at my TIA. That does not mean you should change your portfolio. 3% forever is a money loser. Even though you never have a bad year and you know exactly how much money you're going to make every year, 3% every year costs the system a lot of money over time, right? The system needs to think of itself as a 30-year-old who's going to invest, and their portfolio needs to last them for 50 or 60 or 70 years out, as opposed to me, who's looking at rebalancing my portfolio because I'm thinking I'm going to retire in 4 or 5 years. So the diversity in the portfolio has to be there. If anything, you should be careful about not rebalancing too often, because the data show that putting your money in an index fund outperforms almost every fund manager on the planet over a period of time. And so that's just my advice for the day, is we need a balanced portfolio. It needs to be heavy into things that are going to perform over time, as opposed to looking at this year and we can't have a bad year and not be able to pay out. Nobody should be using money from an investment portfolio at a campus to fund ongoing expenses that need to be funded every year, because that's not what these things are for, and that's not how their return, that's not how you think of their return, right? You think of the discounted present value of their return over a period of time, not individual year to year in their return. Thanks.
Okay, SCS, is there any public comment? Thank you, everybody, for being here. Thank you very much for being here.
Yes, sir.
Regent Borland,
Yes, sir.
you have,
Thank you. Yes, I have a public comment.
okay.
And this time I'll stay where I'm sitting and I will not come there and say it. I will say it from here. My public comment is this. It's going to be similar to my, what's it called, new business. I think it's about time that this board and especially you did a service to the public and to the NSHE public specifically and made them aware of this situation. BDS is just a small part of it. It needs to be made clear to everybody what's really happening, what we need to be aware of, what we need to do to keep our students safe, what we need to do to keep staff, faculty, administration, everybody safe on our campuses. This is not something that's going to go away. It hasn't gone away for 2,000 years. It's not going to go away now. So people are unaware of these things. They ask me the questions. I answer them to best of my knowledge and truth. And I would request that this board, and I hope that others will do the same thing on the board, that we make people aware. We are in the education field. Let's educate the people about what's happening. Let's educate NSHE, because I find a lot of people are uneducated about this and they don't care. But when you don't care is when you get stabbed in the back. So that's my only request. That's my public comment. I wanted to make it for the record, as they say. Thank you, Chair. I appreciate it. That's it.
Thank you. Regent McMichael, was there a comment that you wanted to make as well?
I was just waving by.
Okay. Thank you. Have a great day. Seeing that there is no more public comment, this meeting is adjourned.